Hey everyone, Coach Investor back to another video for today, and unfortunately we have to talk again about the SVB situation right now. Maybe some of you might be tired of hearing about this, but I think it is important to know what exactly has gone wrong, what is going on currently. Of course, when you're watching this video, I don't know when that will be. This video will go live on Sunday, but you might be watching this on Monday when the market is already open and the story is completely different, for the good or the bad. But from everything I've heard, learned, read, listened to the podcast as well, All In, for example, lots of useful information there. If you go on Twitter, lots of people are talking there as well. So lots of things are changing extremely fast in the last couple of days, but also in the last couple of hours. I just started filming this and we already have some news with regards to what might happen on Monday. So FDIC races to start returning some uninsured SVB deposits Monday. Initial payouts depend on efforts to sell assets over the weekend. Figures floated behind scenes range from 30% to 50% or more. Now, what's important here is this right here, uninsured SVB deposits. Why is this important? Because, well, the FDIC insures the amount up until $250,000. How can this be a thing, right? Silicon Valley Bank, lots of its clients, maybe even most of its clients, have millions. For example, Roku, 25% approximately of the cash and cash equivalents it had reported in the last earnings report. Over $400 million sits at Silicon Valley Bank. So that $250,000 really won't move the needle. Roblox has around 5% there. Other companies have some money there as well. Huge one, Pinterest, Airbnb, etc. A lot of people, a lot of companies have some part of their cash stored with Silicon Valley Bank. Why? Because it is a reputable bank. It has been there for over 40 years. It has helped a lot of startups, start and become the companies they are today. It is an extremely valuable component of the innovation industry, of the high-tech industry. So yes, in some part, it needs to be saved. Do the people working there that did not do their job correctly, do they need to be compensated like in 2008 where the, let's say, rich people were bailed out but the quote-unquote poor people were left behind? No. Who needs to be saved right now is the small to medium-sized businesses that are customers or were customers of Silicon Valley Bank. Those are the companies that need to be saved. Otherwise, you're just erasing, removing years and years of work, of innovation, past, present, and future like that. Why? Because some people did not do their jobs. People at SVB, Powell, Yellen, and probably some others as well. We're going to talk about all of this in this video, but I'm going to show you one extra thing before we really dive into this. Screenshot this or go on Twitter and look up unusual whales and you'll find this picture. So before the collapse, executives sold shares. Gregory Becker, CEO, sold 11% on February 27, 2023. Michael Zucker, counsel, 19% on February 5th. Daniel Beck, CFO, 32% on February 27. Michelle Draper, CMO, 25% on February 1st. And apparently bonuses were handed out as well. So of course, this does not paint a nice picture, especially not for the public who is very much tired of their tax-paying dollars going out to save bank or CEOs, executives at banks, just like this one right here. But in this case, things could get much better very fast if things get handled in the right way. Now, for those of you that don't know exactly what has happened, I'm going to explain it in just a second. If you enjoy this type of videos and find it useful, leave it a thumbs up, subscribe if you have not, and if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So basically, as I mentioned in the last video, if you want to watch that, it's pretty funny how things unfolded pretty fast. Basically, on Wednesday, CEO put out a letter saying, look, stay calm. If you don't stay calm, you'll create panic. Panic is unnecessary because panic could create a real problem. Now, why did he say that? Well, because the company was raising money, had sold around $21 billion worth of sort of equities, took a $1.8 billion loss on that as well. And this created, who would have guessed, right? A self-fulfilling prophecy. People started to panic. You call your friends, you call your families. Some VCs are calling their clients, founder funds. is adding fuel to the fire here as well. So what happens? Basically overnight, $42 billion worth of, well, depositors' money went out. Now, of course, this is a shock that a bank like Silicon Valley Bank, which again is a top 20 bank, could not have or did not expect to happen. And this is why maybe the CEO warned and said, look, stay calm, no need to panic, because if you might panic and if you will panic, then this might create a problem that should not have happened. And again, this whole situation could have been avoided. Now, if you need an example, and this might sound weird, I'll use the Madoff example, right? The Ponzi scheme. Why do I use this example? Because, well, Madoff's scheme actually worked for a long time. Why did it work? Because nobody was asking questions, right? Nobody came and said, look, I want to have my money back, give me my money back. But what happened when suddenly 1, 2, 3, 4, 5, 6 people wanted their money back? Well, guess what? The problem started to become bigger and bigger, since one person's money was used to pay someone else, and then if a lot of people at the same time want their money back, and suddenly, well, they notice, well, there is no money, what's going on here? Everything's fugazi, it's a wazi, it's a woozy. Well, it all blew up in their faces. You can take this story and think about a run at the bank and say, looks a bit of the same. Of course, the bank, SVB, is not a Ponzi scheme, but the end was the same. Everybody was thinking about themselves. Everybody went and said, well, I don't want to wait this out. I want my money now. Maybe I should call my friend. Maybe I should call my family. Let's go all and take our money out. Then the event will happen. Well, panic, problem, no money, closed. And of course, there are some people that are loyal and that are standing behind SVB and want to support it if it survives, etc. There's a picture that will come up on the screen with a lot of VCs and whatnot, billionaires that are standing behind. But I can assure you one thing, all of these people have called their, well, portfolio companies and told them, get your money out as soon as possible. Why? Because this is the selfish thing to do, but also the responsible thing to do. So, of course, those that were maybe loyal to SVB and stayed and said, look, I want to support it, I'm not going to panic, blah, blah, blah. Well, they are now stuck and have no money. Maybe eventually they'll get their money back, who knows. But those that were selfish and were actually managing their business correctly, got their money out and are quote unquote safe right now. And now, just as it was easy for this situation to be avoided, it's very, easy to get out of this situation. Basically, the Fed needs to say, look, the depositors are safe, they'll get their money back. And that's how you calm everyone, that's how you calm the situation. Because if this does not happen, this will not only affect SVB, this will basically send a signal to everyone that has their money outside the top 4 banks and tell them, maybe my money isn't safe there, so let me go and grab it and run. And this will just cause bank runs across the country and create another bigger problem that, again, I'll repeat it, should not have happened from the start. And this is why a lot of investors, a lot of people with a lot of money and contacts are begging the Fed regulators to step in, the government to step in and save the situation. Because if it does not get solved, or if they do not say the depositors are safe, etc., before the market opens on Monday, well, expect a huge bloodbath. Because again, this is not just about saving the bank. Forget about the bank, forget about the executives there, forget about the stockholders. It's about all the companies attached to that bank. All the startups, they'll go bankrupt. They can't pay the employees, they can't pay the bills, right? Can't pay employees, can't pay the bills, can't pay rent, can't pay mortgages. So the ripple effect goes on and on and on. The dominoes are falling and going from just a bank to just a small startup, to just one person at that startup, to that person not being able to pay rent, to that person that is renting out the space, not getting money anymore, which means that maybe he cannot pay his bills anymore. And the story goes on and on and on. And that's how you go from a small snowball at the top of the mountain into a huge one that is rolling down the mountain and going to hit that little village down there. Now, in a strange way, this is exactly what the Fed actually wants to happen, right? Slowdown in economy, more unemployment, less spending, which means that the interest rates don't have to go up so high. But this will not just slow down the economy. This again will destroy startups, will destroy years and years of investments in innovation. This does not just destroy the past, but this will destroy the present and the future. Now, talking about the Fed, right? Talking about Powell, talking about Yellen. What are they doing? What have they been doing? I mean, how did we come to this situation? They say they are now monitoring, well, Yellen said we are now monitoring other banks out there. What do you mean now? Now you are monitoring other banks out there? What have you been doing this past couple of years? I just don't understand. Because SVB basically did, let's say, what the Fed told banks to do, right? When rates were low and maybe started to go up a bit, well, they told, look, go and get some treasuries, buy some treasuries. Okay, they went and bought some treasuries. Now, for most banks, it's the safest thing, right? It's the safest thing to do. 10-year treasuries at, I don't know, X amount of percent made sense. Now, since those are long-term treasury bonds and most of the depositors for SVB are short-term depositors, this makes no sense for them, especially not when you've seen rates go up extremely fast. Now, of course, you can say, oh, it's the Fed's fault, it's the bank's fault. Both of them are at fault right now. Because the Fed tried to make us believe that inflation is transitory for a long time until, well, they got slapped in the face and this was not the case. What happened then? Well, their hand was forced and suddenly rates had to go from 0 to 5% in record time. Now, here comes SVB's fault, and the people that are working there are very, very bad at risk management. The fact that they are still holding on to their 10-year treasuries, which were worth much less now, because, well, if you buy the things now, you get 5.28%. Those that they held was what, 1 point something percent or something like that. Since this is a long-term thing, 10 years, and most of their clients are short-term depositors, it made no sense. Now, of course, in a normal scenario, they could say, look, we're just going to sell what we have right now and deal with it. Fine, this could have been the case and would have been fine if, let's say, up to 20 to 25% of their depositors were coming to get back and get some money. Now, if it's over that amount, they would have been in trouble. And that's exactly what has happened. And not only that, if you looked at the SVB quarterly earnings, you can see that their deposits have been slowing down while their OG, let's say, companies are still burning cash and actually burning more cash than before. So you can do the math, right? 1 plus 1 equals 2. When you have less deposits, less people putting money in, and your existing clients are in need of more cash much faster, well, instead of going up, you're going to go down pretty fast. So now going back to Powell and Yellen. What are they doing? What were they doing? Again, inflation is transitory. Oh no, actually it's not transitory. We have to pick up the rates. Rates have to go from 0 to 5 in record time. Let's break the whole system. Let's break the whole economy. Fine. If you're doing that, why are you not keeping an eye on the banks? This is not a small one. This is a top 20 bank. Top 20. Why have you not been looking at it and say, what's going on here? Some of the things here are trending in the wrong direction. Maybe slap on the wrist, I don't know, call them, send them an email, a fax, something. Wake up. Clearly, they did not pay any attention. And of course, we can come back to the point where one says, well, this would have never happened if there was no run on the bank, which again, you could have been correct. But on the other side, the people at SVB were very, very bad at risk management. They had no business in buying long-term treasuries while attracting and having, well, most of their clients were short-term depositors. It just didn't make any sense. And if they actually knew and saw what was happening, right? Because we are talking about high interest rates for a while now. Act accordingly. Act accordingly. Take the loss ahead of time, not right now when you're near the finish line. And literally, you're finished, you're done. It's a series of unfortunate events that happened extremely fast It could have been avoided. It should have been avoided. Hopefully this video goes live and we already have a positive answer. I'll be very, very happy with that. Otherwise, I think we're in a rough environment. And who knows what might happen, who knows how bad things could be. I'm not here ringing the alarm bells and this is doomsday scenario, etc., etc. No, but let's be real. This should have been avoided, could have been avoided. Things also smell a little bit fishy because, well, again, everybody is looking out for themselves. This could have been sorted out already Friday as well. One of the big banks comes in, buys it out or says we're going to buy it out. Deposits are safe. We're done. Friday, story is over. Now the fact that this has run loose, I don't know, seems very, very strange to me. But hey, do share your thoughts down in the comments below. I know this have maybe gone on for, maybe a bit too long, longer than expected, but it's an important thing to talk about. I know we talk about volatile stocks here, volatile companies. So of course, some of these companies might be affected by this or by the likely or unlikely outcome of this story. I know a couple of companies that I've worked with where the payments did come from Silicon Valley Bank. I still have the email, which again, okay, we'll see what happens there. Hopefully everybody gets out of this situation with just a minor hit and not a huge hit. Hopefully no huge or small startup will go bankrupt because of this, because to be honest, it's a shame. Those startups should really not be the one being punished in this situation. So again, share your thoughts down in the comments below. If I missed something, if you want to add more value, more information, do it down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I see you all in the next one. Bye bye.